afternoon. This is Lance Bryce with Thrive Mortgage. Today is Thursday, the 6th of January. I hope you're doing well. I'm going to take a little bit more time on today's video to talk a little bit about where we are today and where we are hoping to be this coming year. So we might go 4 minutes or so bear with me. We are sitting, according to the Mortgage News Daily tracking poll of the 30-year fixed conforming loan, at 6.20% today. That's about a third of a point less than it was this time last week. And that's a bit unexpected. We had non-farm payroll this morning that came in, at least the headline number came in quite a bit stronger than expected. Would have expected bonds to sell off badly and rates to kind of sharply tick upward on that news. But as with all things related to interest rates and inflation, the devil is in the details of that report, or in this case, the angels were in the details with regard to rates. When you look at some of the internals, you see, number one, the last 2 months of non-farm payroll were revised downward significantly. So those reports were actually weaker than what was reported in the headline number. In addition, we saw the wage growth has slowed significantly. This is one of the things that the Fed is concerned about, that wages are going to increase at a level that sustains current pricing levels, in which case you're going to have wages and price increases kind of spiraling together to take inflation higher. Well, getting that component today that shows that wage growth is actually slowed was a key component, and that's what the markets are rallying on today. You see both stocks and bonds rallying strongly today on that news. The Dow closed up today over 2% higher, 700 points higher on the day. When you look at the Dow over the last 12 months, though, kind of a year in review, Dow's down a little over 7% for the last 12 months. So we saw a lot of weakness in equities due to inflationary concerns. And to talk a little bit more about inflation, we haven't really talked about government spending much, y'all. Everyone knows that government spending is a key component of inflation. Let's talk a little bit about government spending, though. When you look at the last 2 years, we have spent $14.7 trillion at the federal level. Now, that includes the omnibus bill that was just passed 2 weeks ago. That bill rattled the markets. That bill by itself exceeded the entire level of government spending in 2017. We only spent $1.1 trillion for the entirety of 2017, and we spent $1.7 trillion in a bill that was passed the third week in December with broad bipartisan support. Y'all, that was in addition to the $6.3 trillion that was already spent in 2022. That's in addition to the $6.8 trillion that was spent in 2021. Here's why those numbers are important. When you spend almost $15 trillion in a 3-year or a 2-year period, and you only collect a little less than half that in taxes, you have to borrow the difference. And of course, there's not enough borrowers to buy the bonds to finance that degree of deficit spending, so the Fed steps in order to buy those bonds. And that's what we have seen happening over the last several years to cover that degree of deficit spending. That's how the money gets printed. That's how those additional dollars find their way into the economy. That's the mechanism by which that happens. The Fed buys by sending a wire to the CBOT to buy treasuries and mortgage-backed securities in huge tranches to finance our federal debt, or at least in large measure to do so. So that's what we have seen, y'all. That's how this money gets into the economy, and the economy has a very difficult time digesting that degree of deficit spending, and it leads to inflation, which is what we're seeing. Congress needs to do its part and slow the rate of spending. One of the reasons that we are seeing such a strong rally today, I believe, is we had a number of concessions made in the speaker's fight today that will, in fact, have a material effect in curtailing spending. There will be an opportunity for bills to be debated on the floor in such a way that spending in those bills can be curtailed. Markets like that. That's why you're seeing strong rallies in part. It's not just the non-farm payroll today, it's also the movement in that speaker's race, which looks like it's coming to a resolution now, with frankly some fiscally responsible policies potentially finding their way back into government discourse. So let's hope that that continues. Let's look at next year. Y'all, one of the sources that I use is a program called MBS Highway, Mortgage Backed Securities Highway, and it's run by a gentleman named Barry Habib, who for the last 25 years or so, has really been one of the key economists in predicting quite successfully over the years both daily, weekly, and yearly moves in interest rates. And his predictions are very strong for the coming year. He sees rates by mid-year in the low to mid-fives. He sees single-digit house appreciation this year, so slowed but still appreciating. And he sees significantly more housing activity throughout this year. Reasons for that are multifold. Y'all, I have a full presentation that I am more than happy to bring out to your respective offices. I would be happy to present this to kind of give a heads up on where we think the market may be headed in 2023. I agree with a lot of Barry's points. We all know that inflation drives rates, and inflation is moderating. Every key component shows that it's moderating, and every future month that we get that shows rates are lower from the prior component year-over-year months that we're comparing it to, we will see rates continue to moderate. Mortgage bonds are significantly higher than they should be in relation to U.S. Treasuries. We will see that moderate and correct itself. That in itself could give us, 3/4 of a point, if not a full point of rate relief, just getting mortgage bonds back in line with pricing for U.S. Treasuries. Y'all, there's a lot more to this. I know this call has run a little bit long, but if you would like for me to come out and visit with you either individually or visit with your offices at a future meeting, I would be happy to do that and do a full presentation around where the future's headed for 2023. In any event, I hope this information is helpful for you and for your clients. It's why we do it. We're always honored by your referrals. All my contact info is on the screen. Have a great day, have a blessed week, and let's have an awesome 2023.